Alright, my name is Jacob Faust, and this is going to be my Bloomberg investment analysis. Our goals for this analysis is going to be to analyze 5 different companies across 2 different industries. We're going to then pick the best company from each industry, and then out of those 2 companies, we're going to pick the best company to invest in overall. The first industry we're going to look at is the gaming industry, and the companies we're going to look at in that industry is Electronic Arts, Take-Two Interactive Software, Activision Blizzard, Konami Holdings Corp, and Nintendo. Then we're going to take a look at the adult beverages industries, and the companies in this industry we're going to look at are the Craft Brew Alliance Incorporated, Boston Beer Company Incorporated, Constellations Brands Incorporated, and the Molson Coors Brewing Company. And we have the ticker symbols here for those companies. The basis of this analysis are the criteria that we're going to be looking at in this analysis. We're going to look at short-term solvency. We're going to look at the cash ratio, quick and current ratios. And we're also going to take a look at long-term solvency, being the equity multiplier, and the total debt to equity. Next, we're going to take a look at asset management and just take a look into the total asset turnover. Profitability ratios we're going to look at are return on assets, return on equity, and the company's profit margin. And then we're going to look at the market value, being the company's price earnings ratio and the company's market to book ratio. And we're also going to look at each company's economic value added. So first, we're going to start off with the gaming industry, taking a first look at the current ratio. And the current ratio shows the company's current assets to that company's current liabilities. So we can see here that the 3 companies, EA, Konami, Take-Two, and Activision, kind of hanging out together at the bottom. And we have Nintendo up way high above those other companies, but also taking a large dip in 2016 and kind of continuing to dip off into 2018. Now, I know it's in the middle of 2018. These numbers are to this month of 2018. We can see that EA and Konami kind of follow a same trend. Activision and Take-Two fall. However, EA and Konami rise. Konami falls slightly in 2017. So in this ratio, I think that I like EA the best overall. And now we're going to take a look at the quick ratio. Now, quick and current ratios are very similar. As you can see, if I were to go back to that ratio, and this one, the quick and current are the same. See, current, quick, very, very similar trends here. That's because the quick ratio just subtracts inventories from the numerator of the current ratio. So we're going to see following almost the same exact trend. And again, I like EA with the quick ratio too, because I like the steady growth of that firm. And you can still see Nintendo way up, but also falling way back down even with them here in 2018 and continuing to fall. Next, we're going to take a look at the cash ratio. Also kind of follows the same trend here. And this is showing how, the cash ratio is showing how liquid companies are. Okay, so we've got Nintendo again being way up high above the rest and falling. You know, they're up around 9. We got everybody else not really going over 3. But you can still see, you know, the cash, current, and quick ratios are going to be very similar. But you can still see all the other companies kind of falling in some sense at some point. Konami falling steady, but then eventually falling. I'm going to also say I like EA the best on this cash ratio graph here. Next, we're going to look at the equity multiplier. And touching back on these ratios, I like these short-term solvency ratios. I like EA in the short term because it's on a steady rise throughout. It never falls negative. I like its steady rise. So I'm going to pick EA in the short term. Equity multiplier is going to be a ratio of assets to a company's equity. You can see, again, Nintendo up way above the pack. However, they, after 2016, I don't know what happened that year, but just falling off. They're falling off bad, and they continue to fall off, falling off into 2018. Take-Two and Activision, very similar. And you got, well, Take-Two and Konami, very similar. We got EA on a slight decline, not much. So that's it for the equity multiplier. Next, we're going to look at the total debt to equity of a firm. And the total debt to equity is going to be calculated by dividing a company's total liabilities by its stockholders' equity. And this measure is used to measure a company's financial leverage, how much debt is being used to finance its assets. And you can see that all of these are declining, which is good. Take-Two declining a lot after 2016. I like EA on the rise a little bit here. And also we didn't get any, we had just 0 for Nintendo. But we got EA on the rise a little bit, then coming back down, so I guess they corrected that. And you can see here Activision on the rise a little. But I think overall here, I mean, everybody's in pretty good standing here as long as it's going down. So next we're going to look at the total asset turnover. The total asset turnover is going to be the sales to assets preferred, and this is preferred to be a high ratio. So you want to see it. You want to see the higher numbers of this ratio. In 2014, we got Take-Two looking really good, way up there. They dropped in 2015, which is okay, dropping back normal with the industry. So in this ratio, I mean, you can see everybody's relatively the same here. We got a jump in Nintendo from 2017 to 18, which I kind of like. I mean, it's always good. Like I said, a higher total asset turnover, the better. So next, we're going to look at the profit margin of a firm. And you can see that we got Take-Two dipping into negative numbers, which is never good. And they're dipping into negatives on the profit margin. They corrected after 2015. I guess they made some adjustments. 2016 looking good. 2017 throughout steady on the rise. I like EA here. You know, no real decline in their profit margins. Steady increases all across the board. Let's go back. Skip it. Let's go back real quick. Okay, profit. Here we go. Steady increases across the board with EA. You never want to see a declining profit margin, but so you know, I'm gonna have to say that I like EA the best on this graph also. Our return on assets. This is how profitable a company is relative to its assets. Again, Take-Two dropping into the negatives in 2015, but again correcting and bringing it back up in 2016. You can see the difference in the numbers here. These graphs are very similar also, but there is a difference in the numbers. You see as a click. But again, EA just steady with the growth, a slight kind of, I wouldn't really call it much of a decline, more of maybe a leveling out here. You got Activision staying very level throughout and then dipping slightly in 2018. And Konami on a steady rise throughout, actually. So they're looking good. Now we're going to look at the return on equity. This is returns from shareholder earnings of a company. So again, you can just see that. I mean, it's consistent throughout. Oh, I'll keep clicking it. It's consistent throughout. You can see that drop in 2015 from Take-Two, but you can still see. I mean, these two are going to be similar also, but they're different in their own sense. But you got EA kind of on the rise and leveling back out, and Konami just on a steady rise throughout. The price earnings ratio each firm, this is a stock price to the firm's earnings per share. So Bloomberg did not have the data from 2014 and 15 for any of the firms except EA. I like EA's steadiness. I've seen steadiness from this company throughout this whole research here. I like the way they look throughout and the way they're going. And we can also see Activision on a steady earnings. And we can see Take-Two dip a little bit after 2016 but come back up. And then Nintendo dipping into 2018. The market to book ratio, again, didn't have the data for some of these companies is missing, but it's okay. We're just going to move on. We can see a rise throughout from all firms, really. Activision and EA taking a very similar path. You could barely see the difference in the line there. Not much, but taking the very same path. You can see here how Take-Two bounced back from those falls in 2014 and 15 and coming into 2016 through 18 strong. The enterprise value, this is always good to see this on a constant growth and high numbers as we can see here from each firm, adding this is their overall value of a company. So as long as that's going up, that's a good thing. And a gaming industry conclusion, best overall, I'm gonna go with the Electronic Arts Incorporated because they're steady on cash, current, and quick ratio graphs, keep a constant growth throughout, and they dominate the ROA and ROE graphs. Also, to me, they indicate a low volatility. I like their constant growth. I like how steady the firm is. They, if they dip a little bit, they immediately correct it the next year. So I like that about that firm. Now we're going to move into the adult beverages industry. Here, looking at the current ratio, we can see the Craft Brew Alliance on a steady gain and then jumping in 2017, dipping right back down, but nothing bad. If you can look from 2016 to 18, they're still positive. So as long as they can keep growing on that, that's a good thing. Quick ratio here, we can see a different. These are not as similar as it was on the in the past companies, but still you can see the Craft Brew Alliance steady growth, and we have Moore's Brewing Company staying. They're lower on the graph, and they're consistently falling. Here we have our cash ratio, and again, the cash ratio is showing how liquid the companies are. So we can see Craft Brew Alliance relatively maintain the same slight spike in 2017. Again, I'm all about consistency. I like that. I don't like how Boston Beer Co. is way up and falling. However, they're still up above. They're still sitting up above the graph, which is always a good thing too. Here we're looking at the equity multiplier for the beverage companies. Relatively through here, consistency throughout the board. I mean, you can see industry-wide how this is, relatively even. Slight changes throughout the years, not too much to scare us there. The total asset turnover, again, this is the sales to assets. It's preferred to be a high ratio. Above 1 is a great thing. So I like how Craft Brew Alliance, they fall slightly from 15 to 16 and on into 17, but they're picking up and they're staying above 1, which is a good thing. Boston Beer Co. Staying high for the majority of the time, but I like the way Craft Brews grow in there. And Constellation Brands and Most and Coors Brewing, not bad, not terrible. You don't want nothing below 0. That would be bad. But anyway, so I like the Craft Brew Alliance on that. Also, profit margin. Again, we can see Craft Brew Alliance, staying steady, adding a little growth. You can see them dip slightly in 2017, but bouncing back. I like Boston Beer Co. in this too because of their steadiness. Monsoon seeing a big spike here from 2015 to 16, but dropping right back down to 2017. So, and then we see Constellation Brands falling, but picking back up on into 2018. ROA, return on assets, how profitable a company is relative to its assets. Talked about that. Here again, you can see Craft Brew Alliance following that same trend across the board of a slight dip in 16 and just coming out of 16 strong and maintaining strong. Boston Beer Co. is, above the graphs. You can see them kind of following that same trend of Craft Brew Alliance. Constellation Brands dip a lot. They're bringing it back up. I don't know if I like that volatility of that firm, really. And you can see, again, the Coors Brewing Company with that big spike in 2017 and coming back down, but not coming back down in a bad way, coming back down even with the rest of the industry. Now we're going to look at the return on equity. And you can see, if I click back, the similarity of these. They do have a dip, but you can not similarity in the numbers, but the trends of the graphs. So you can tell how the companies are moving across the board. Craft Brew Alliance, again, that dip and coming out strong. I like the steadiness here of Boston Beer Company. And again, the return on equity, what we're looking at here is the return from a shareholder's earnings. So that's all we got for RE for our adult beverage companies. Then we'll move to our PE ratio. I'm missing a piece of information I really wanted. Bloomberg did not have the 2016 reports on this from Craft Brew Alliance. I want to know where they went here, where they went wrong. Something fell. However, I'm still liking this company across the board. You can still see that spike in Coors Brewing here in 2016, and Boston Beer Co. and Constellation Brands Company really following that same trend across the board. Market to book ratio. This is going to be the value of a company to the book value of that firm, to the book value of the firm. Craft Brewer Alliance, growing, steady, steady putting that growth on. You can see a dip here in Boston Beer Co., but they seem to recover and get back in line with the rest of the industry here. Constellation Brands, steady growth across the board there on that one. So now we're going to move to the economic value added. This is a very important ratio here. We looked at the enterprise value of the gaming companies. I'm going to touch on the economic value added of the adult beverage companies. This is value created in excess of the required return of the company's shareholders. So whatever they require, this is money we're making here. So I like this. This is always good to see a big spike here, but they're coming out of the negatives. They pulled out. You can see zeros how they're negative. Pulled out of the negatives, fell back down below the negatives, which is not good. You can see Craft Brewer Alliance a little negative here in 2016, but pulling back out, sticking with that same trend they kind of had. Boston Constellation Brands looking good, staying above zero. Had a little fallout after 2014, but that's okay. But I like the consistency of Craft Brewer Alliance meeting their returns here for their shareholders. All right, so the conclusion on the adult beverage industry, best overall, I'm going to have to go with the Boston Beer Company Incorporated. It shows consistency. It has a small dip in 2016, but seems to have corrected well by bringing the growth from 2014 and 2015 back by showing good numbers in years 2017 and towards the year end 2018, moving into 2018 up until this point, they have shown great numbers. So I'm going to go with best overall being Boston Beer Company in that industry. So a recap of this analysis, we analyzed 5 companies from the gaming industry and 4 from the adult beverage industry. Looked at various ratios indicating different forms of growth and trends within firms. Picked one company from each industry that was, in my opinion, the best investment of this particular set based on the data that we analyzed. All information used was pulled from Bloomberg and are shown in values listed as per million. And my overall best pick out of both industries, my best investment from this is going to have to be EA, Electronic Arts Incorporated. I really like this firm. I like its consistency. I like its growth. It dominated the current, quick, and cash ratios. RE, RA, always solid, always steady. Enterprise value constantly going up. They had a good EVA. Overall, I'm going to have to say that this firm is the best investment. And that's all I have for today. So thanks.